Hello traders, this is the weekly market update podcast from the pipwisebroker. We start from the economics and from the United States as usual. Last week the US elections were held, which resulted in a much derided red wave wherein the Republicans won in all the battlefields and Trump was elected as the 47th president of the United States. The Republican sweep in the US elections could have substantial implications for economic policies, markets, and international relations. A Republican-controlled government is likely to push for policies that favor deregulation and tax cuts, which historically have been seen to stimulate economic growth, at least in the short term. There might also be a focus on domestic energy production and a reduction in government spending on social programs. Investment markets may react positively in the short run due to anticipated corporate tax cuts and deregulation, which tend to boost stock prices, especially in sectors like energy and financial. However, there is also a potential for increased market volatility as investors assess the impact of these policies on inflation and interest rates in the longer term. On the global stage, a Republican sweep could lead to more nationalistic and protectionist policies, which might increase tensions with trade partners and could affect global markets and the U.S. relationships with other countries. Overall, while there may be an initial positive reaction in markets, and especially for the U.S. dollar, the long-term economic effects will depend on the specifics of the policies enacted and their execution. Last week, we also had the FOMC rate setting session wherein the Federal Open Market Committee decided to lower the Federal funds rate by 25 basis points to a range of 4.5% to 4.75%. This move continues the rates cutting cycle that began earlier in the year, reflecting the committee's judgment that inflation is moving towards its 2% target but remains slightly elevated. The Fed also continues to reduce its holdings of U.S. Treasury and agency mortgage-backed securities. The economic outlook remains uncertain, and the Fed is closely monitoring data to guide future adjustments. During his press conference after the session, FOMC Chair Jerome Powell emphasized the Fed's ongoing efforts to navigate the economy towards a stable state despite external pressures and uncertainties. Powell stressed the Fed's intention to maintain a middle path in adjusting interest rates, aiming for a neutral stance that balances between preventing inflation surges and supporting the labor market. He acknowledged that although the labor market has shown signs of cooling, it remains in a generally good condition. Powell also commented on the recent U.S. presidential election, clarifying that while the election's results might have long-term economic implications, they do not alter the Fed's immediate plans. He highlighted the importance of monitoring economic indicators closely rather than reacting hastily to short-term fluctuations. Furthermore, Powell reiterated his commitment to his role, responding with a definite no when asked if he would step down upon request by the incoming administration, underlying the independence of the Federal Reserve in its decision-making process. Another positive data coming out of the US last week was the ISM Services PMI, which registered at 56%, marking a significant improvement and the highest reading since July 2022. This increase was driven by gains in business activity, new orders, and employment indexes, which all exceeded their annual averages, suggesting a robust economic activity in the services sector. The employment index, in particular, saw notable growth, indicating positive labor market conditions despite external challenges like hurricanes and a furlough jobs report showing only modest job additions. The overall expansion across various industries signals a strong performance heading into the holiday season. Elsewhere in the world, in the United Kingdom, the BOE, or Bank of England, decided to cut the bank rate by 25 basis points to 4.75%. This decision was influenced by a combination of factors, including a decline in CPI inflation to 1.7% in September, which reflects ongoing disinflation, particularly in goods prices, while services prices inflation has been less pronounced, but still decreased. The bank also considered the economic implications of the autumn budget 2024, which is expected to modestly boost GDP and CPI inflation due to fiscal policy measures such as increasing employers' national insurance contributions and national living wage. The MPC, or Monetary Policy Committee of the Bank of England, continues to adopt a forward-looking and data-dependent approach to meet its 2% inflation target and sustainable growth. However, despite the rate cut, there remains uncertainty around the labor market and its influence on inflationary persistence, with potential structural shift in the wage and price-setting behavior being closely monitored. In Canada, the employment data showed that the Canadian economy added 14,500 jobs in October, maintaining a stable unemployment rate of 6.5%. This performance was somewhat below market expectations, contributing to a cautious response from investors who are closely monitoring these economic indicators to gauge the potential for further economic cooling. Overall, while there is ongoing job growth and wage increases that continue to outpace inflation, the moderate pace of these changes and the broader economic indicators are leading to a mixed and cautious market reaction. In Australia, last week, the RBA, or Reserve Bank of Australia, decided to keep the cash rates unchanged at 4.35% in line with market expectations. This decision reflects the RBA's assessment of the current economic conditions and their implications for monetary policy. The RBA's cautious stance, while acknowledging the high level of inflation, seems to align with their priority to sustainably return inflation to their target range, and this approach likely contributed to the market's perception of a more hawkish policy outlook. In New Zealand, the unemployment rate increased slightly to 4.8% in the third quarter of 2024 from 4.6% in the previous quarter, according to the Statistics New Zealand. This was lower than the anticipated 5%. The period also saw a 0.5% decrease in employment and a reduction in wage inflation, indicating a contracting economy. Consequently, the loosening labor market may allow the Reserve Bank of New Zealand, or RBNZ, to reduce interest rates further to stimulate economic growth. Despite the decline in participation rates and employment, easing wage pressures are aiding in controlling inflation. In the geopolitics area, the Indo-Pacific region has seen increased military and economic tensions. The US and its allies have been actively conducting military exercises to assert their presence and commitments in the region, particularly concerning the security of Taiwan and maintaining freedom of navigation in the contested waters like the South China Sea. Even though we witnessed high-level diplomatic efforts, such as a visit by the U.S. National Security Advisor to Beijing, the de-escalation process appears unlikely to bear any result right now. For the next week, we will hear about the UK job market, US CPI and retail sales report, and Australia CPI and job market reports. The market will also pay attention to what will the Jerome Powell, the Federal Reserve Chairman, will say about the recent decision by the Federal Reserve Open Market Committee to reduce rates by 25 basis points. Good luck.